All right. All right, everyone. We have our next speaker, Zandile Nkwanyana from 361 Asset Managers, and talking about the investment challenges and opportunities. She'll be taking a look at the local and global investment opportunities. Zandile joined 361 investment team in August 2021. She's been in the financial services industry for 13 years, which includes investment banking at JP Morgan. She has an MBA from the London Business School, a Bachelor of Business Science degree from UCT, and she's a chartered accountant. Zandile is one of the few people that moved. She was overseas and she came back to South Africa for her love for South Africa, and also she could not live without braaivleis and Woolies food. Ladies and gentlemen, Zandile Nkwanyana.
Is this, oh, great. Good evening, everyone. Oh, Molo. So I'm Zandi from 361, and tonight I'm going to chat to you a bit about some of the opportunities that we're seeing in the markets. You know, Isak painted a perfect picture of how challenging the world is right now and how uncertain it is. So as asset managers, where on earth are we putting our clients' money? That's what I'm going to cover. And then we'll also chat a bit about hedge funds. But before we get there, just a brief introduction to 361. So it is pronounced 361, not 360 ne, as some people call it. Yeah. I mean, we've been around for about 20 years, and as I was listening to the GMI story, it's interesting. It's quite similar to ours in a way, because we were founded by two people, my bosses, Sai and Steve, who were working together at one of the big banks, and they just got really frustrated with, you know, just all of the red tape and how a lot of their time was spent on things that weren't adding value to their clients. So their goal was to build their own investment firm that was just focused on performance. And that's all we do. We've got a flat structure. We've got a team of about 12 investment professionals, and all we have to worry about is performing. And so we're quite lucky. We've, you know, lasted 20 years, and we've been able to deliver for our clients. We've now grown. We've got an AUM of about 50 billion rand. And so that actually makes us one of the smaller asset managers in South Africa, and it means that we can invest across the whole JSE. So a lot of companies aren't too small for us, and for us that's a really cool thing because it means we've got a bigger opportunity set, and I'll cover that in some of the companies we chat about today. And just the last thing to mention, we also manage a wide variety of different products, hedge funds, long only, multi-asset. And the reason why that's quite important is because we think that each of these products has its place in a portfolio. And I'm really excited to chat to you about hedge funds when we get there. So where are we seeing all these opportunities? Well, I don't know about you, but I've been pretty terrified so far this year. You know, I won't go into details about what our thoughts are around Trump. We've already covered that quite well. But the point is, at this moment in time, the macro, the global picture, is quite uncertain. And so the type of instruments and asset classes we're preferring right now tend to be a bit more conservative than we normally would. We really like gold. We think that when you look at safe haven assets, that's one that's very attractive right now. And what you're seeing is that it's not just us investors who are buying more gold. A lot of foreign governments are also buying gold. As soon as, you know, Russia invaded Ukraine, we saw the US weaponize Russia's reserves. And a lot of these different countries had to diversify into an asset class like gold. And so when you think of high uncertainty, a potentially weaker dollar, and an inflation picture that's a bit uncertain, gold is where you want to be. So let's dive into SA specifically. If we're looking at this year, where does our team think that were probably going to be able to win in the local market? Well, we think that SA needs to grow. That's going to be the really important thing this year. And we're actually in quite a fortunate position. It might not feel like it, but we're kind of lucky because we've got a lot of self-help stories, meaning that we can do a lot of things right that can help our economy improve, so that even if the US is causing all its shenanigans, we might still get some growth. So the first one of those is the reform agenda. It's taken a while. We don't have zero load shedding, but it's a lot better than where we were a year ago. And that's very important for all of the companies that we have listed locally, so they can make decisions and also hopefully save costs from all the money they had to spend on diesel, etc. And the other big elephant in the room is Transnet. Transnet has been holding us back really aggressively. And what we've seen is that there have been major improvements there. When we speak to all the CEOs at the mining teams, they're impressed by the new management team at Transnet and their plans to start working with the private sector. So as investors, we get really excited about stuff like that. Because like I mentioned, no matter what tantrum Trump throws tomorrow, if we fix Transnet, we're already on the right footing for a pretty decent year in equities. So that's something that we think is quite likely to work out this year. We're quite optimistic there. The stuff that we're not too sure about, I mentioned the global macro, and also capital flows. One of the challenges on the JSE is that a lot of foreign investors have abandoned us. All of this uncertainty with the load shedding, the political climate, not really understanding where SA is going to go, has made them rather invest in different markets. And we need them to come back. So right now, we're still not sure if we'll have enough to attract that investment. But in the meantime, as long as we figure out our own story, local investors should be enough to get us by. And then lastly, we do need a SARB that helps us out. And unfortunately, our great governor doesn't really think like that. So his hands are quite tied. He's naturally quite conservative. But we think that if Trump's antics do cause a slowdown in the US, and you get their central bank cutting rates, that means that the SARB might cut rates too. So they've got a lot of room. And if they gain more confidence, that's something that could work out for us. But because they're quite conservative, we're still calling it unlikely. So these 4 things are what we think you need for equities to work this year. If we get 2 out of 4, that will actually be a pretty decent year. If we get 3, then I'll be very happy to stand in front of you next year. And this is something that's also really important to highlight. South African shares are really cheap. And some may argue cheap for a reason. But we think that as long as you have that low starting point, it means, once again, you don't need that many things to go right to still succeed. And so, that kind of valuation buffer, whether you're comparing us to other emerging markets or the US, which is the most expensive market in the world right now, changing a bit thanks to Trump, but still quite expensive. So SA stacks up really well. So once again, just a couple of things working out right could set us up for a pretty good year in equities. And so if we look at our flexible fund, this is a fund that can invest in any asset class. How are we thinking about the opportunities in each of these? Well, you'll see right there, our biggest allocation is to local equities. We do have an equity bias in our firm, but right now we think that SA looks a lot better than other geographies. And even though there is uncertainty, because of that low starting point with valuations, and because of those few things I mentioned that we could do to set us up for a good year, we're a lot more comfortable allocating money locally. So we do have some global equities, and I'll go through those later when I run through some examples of some of the stocks that we hold. And so we also do have a few bonds. It's always good to diversify. Once again, when you're in an uncertain environment where a lot of things could go wrong, and it's difficult for us as investors to assign probability to all of these events, you need bonds as a buffer to your equity holdings, our bonds and our cash. And since rates are still quite high, cash is yielding a pretty decent return, and we're very happy to be in there. And so earlier I mentioned my view on, interest rates, that I think there is a chance we do get lower rates, and that's why we also like property. We have a lot of really good property tickers in South Africa, companies that have gone through a really tough time, and they've learned to be a lot more disciplined with how they allocate their capital. But another really interesting thing about a lot of companies that are listed on the JSE is that even though they're listed here, they have a lot of companies outside of SA. And so you have a lot of our property companies actually owning assets in more exciting geographies like Eastern Europe. That's done very well. So in that property allocation, you can think of it as sort of, thinking about global equities or global property, but focused on the most attractive markets out there. So Europe's been doing very well recently. They've come off this great tourism boom. And right here in SA, you can get access to those markets through property companies like Vukile, Nepi Rock Castle, that actually have assets in these geographies. And with commodity, that's mostly our gold. And so in a fund like a flexible fund, where we have a lot more options within different asset classes, we own the gold counters, so the equities. We have the best gold companies in the world listed right here in SA. Goldfields, AngloGold Ashanti. But we can also hold the physical metal. And so that's what you see there with the commodity. And then we do have some preference shares, and those are mostly issued by our banks. So, floating rate instruments, but very attractive and very high quality credit assets. And so overall, when we think about this kind of dynamic, uncertain world, you need to make sure that you're quite diversified in your asset allocation. So have your equities, but also just balance that with your bonds and even property and commodities like we have. So let's get into some specific stocks. I mentioned the SA market is cheap, so what do I mean by that? Well, we've been excited by a couple of different names this year, and two that I've highlighted here are AB InBev and ABSA. So AB InBev, first of all. Alcohol is a very interesting sector right now, very interesting industry. And what you've seen globally is that people are drinking less, especially younger people. And so that's caused a lot of pressure on the industry as a whole because volumes have been coming down. Look, we might not see it at Rands here in Cape Town on a Sunday, but trust me on this one. Trust me, it's true. And so what you saw is that as volumes were falling off a cliff, these shares were just absolutely hated, and the share price went lower and lower. But these companies are cash flush, so a very strong balance sheet. And what companies can do when their shares get really cheap is invest in themselves. So they go out in the market and they buy their shares. So as shareholders, what happens is, you've got a company, a certain number of shares have been issued, and then if they buy back those shares, there are fewer shares. So even if the company doesn't grow, the pie, and the piece of the pie that you get is actually bigger. And so we like opportunities like that because it doesn't matter if the macro environment isn't doing well, if their sales aren't going up. They've got a lot of cash, strong balance sheet, and buying back shares. So that was a really great opportunity that we saw. And on that slide there is just how the valuation was well below its long-term average, which gave us that attractive entry point. And then ABSA. Okay, I don't know who you bank with, but ABSA doesn't have the best reputation, unfortunately, for best customer service, but they are improving. And those are the kind of companies that you want to find at a time like this. The best ones are normally incredibly expensive, already priced for perfection. But if you find the laggard in the industry, and ABSA's had a couple of issues, especially with their CEO, a lot of uncertainty around the governance in place there. So what our team did at the end of last year, we did a lot of research where we actually spoke to people within the company to find out what's going on with the culture. And as soon as the interim CEO was appointed, we spoke to his colleagues. So we interviewed the CFO, the entire management team around him to figure out if he's the right guy. And we had very high conviction that ABSA had made a very good choice. And so we took a bet on the shares and it worked out really well. So ABSA is an attractive asset because once again, it's cheap, like everything else I'm mentioning, but it also gives you a really high dividend yield. So that means that, even if the share price doesn't go up, you're still getting cash back in the form of dividends. So once again, going back to the environment, those are the type of shares you want to own right now, where you're getting some of your money back every year, rather than waiting, for 10 years, or with some of these US tech companies, you have to take a 50-year view before you can really make money. And then the third one, Tencent. China is pretty unloved. And you can find a theme here where we like a lot of, companies and areas of the market that aren't getting much love from everyone else. That's where you normally see a lot of opportunities. But what's interesting with China is, right now their economy is going through a really tough time. So they had this huge property boom that went bust. And a lot of Chinese individuals or consumers have most of their assets tied up in property. So that collapses your consumer confidence. When everybody's main asset no longer has value, they don't really want to go out and spend money. And so you found that companies like Tencent were affected. Their revenue growth slowed down, but the way that they were able to respond in that environment is by managing their costs. And so we saw a similar thing happen in America, where these tech companies said, okay, it's a tough time, we're not making as much money as we used to, so we're going to fix our costs. And they did major layoffs, which don't sound great, at a high level, but it shows that they were overstaffed and they were able to correct that. And so even as the revenue was going down, the EBITDA margin, which is a measure of profitability, actually stayed consistent. And that's a sign of a very durable business model. So we really like Tencent. We think that they're quite well positioned. And now with China winning the AI race after DeepSeek was released, that makes Tencent even more exciting. So in our flexible fund, we hold Tencent directly. But in our SA equity funds, we hold Naspers and Prosus, which have a significant stake in Tencent. Sorry, I'm used to a mobile mic. And then the last, company I'll talk about is a US company called Wells Tower. So at 361, I'm actually a global analyst. So I don't research South African companies. I research companies anywhere else, which is quite cool. We've had a couple from Poland, Mexico, and this is a US property company. It's in a really attractive market. And once again, thinking about the macro, property companies normally have a lot of debt. And so when interest rates come down, their shares become very attractive. And a company like, Wells Tower is exposed to very attractive end markets, senior housing, healthcare. Those are the type of markets that are quite durable regardless of the way that the economy goes. So even if there's a recession, there'll still be a demand for healthcare. Once again, uncertain environment, Trump causing a US slowdown, this is the kind of stock that we prefer to be in. Great, so those are the specific opportunities, and now let's talk about hedge funds. I absolutely love hedge funds. And they are an asset class for all markets. I'm going to elaborate on that in a bit. So at 361, when we think about risk, this is the graph that comes to mind. So whenever people talk about holding shares, they say, listen, you have to buy and hold forever. Don't get out of the market. Don't do it. And the reason they say you don't get out is, a bit messed up, but that blue line there. So the middle line shows what happens if you're invested in the market and you stay invested throughout this 20-year period. The bottom line says, what if you take out your money and you miss the best days in the market? And that's normally the argument everyone says, don't miss the best days or you won't make as much money, shown by the gray line. But what a lot of people leave out is that when you think about investing in equities, if you had to miss the 10 worst days, i.e. if you had to make sure that you were able to get out of the market and miss all of the absolute worst days, you'd almost double your money over that same time frame. And so we don't just think about the best days in the market, we also think about the worst days and making sure that you limit the downside in your portfolio. And that's where hedge funds come in. So hedge funds have a way to make sure that your portfolio is protected from the market when the market goes down, but still making sure that you actually participate when the market goes up. So what we've shown you here, and I'll get into some of the mechanics, is if you look at the market, so that dark blue line, the all-share index, that's the return that you would get. And the red line is our hedge fund. So the way that the hedge fund product works is that in the worst periods of the market, we've highlighted 3. So let's use COVID-19. Equity markets had a significant drawdown. They went down and they went down badly. In that same time period, that hedge fund didn't go down. So the hedge fund was able to make sure that our clients' assets were protected as equity markets were going down, and as markets started going back up, the hedge fund also went up along with markets. It sounds like witchcraft, but it's really not. This is the way that we do it. So, if you're in a unit trust, which is like being in the markets, 100% equities, you're buying and holding. So you'll always experience those fluctuations. Markets go up and down over time. It's a normal thing. In the long term, they go up. But with hedge funds, you've got a few tools that you can use so that when markets go down, you're still making money. And I'll show that with an example. So this is called shorting shares. The example we have here is a company we all know very well, Sasol. And when we do our research on companies, we try to find out what are the good ones, but also what are the challenged companies. So when we looked at a company like Sasol, you could see that, management wasn't making very good decisions. It had very high debt levels. So we made a call and we said that we think the share price will go down. So when you think a share price will go up, you buy the share. When you think it'll go down, you short it. So what does it mean to short the share? Well, on day one, we go to the bank and we say, hello, Mr. Banker, we think the share will go down. Could you please lend us the share? So then we borrow the share from the bank. And then now that we have the share, we sell it. We sell it at that much higher price because we know the price will go down. And then when the price goes down, we buy the share in the market and we return it to the bank. And then we make a profit on that difference from when we borrowed at the high amount, and then we were able to make sure, we bought it at the lower one. And that's what shorting is. And that's a tool in the toolkit that only hedge funds can do. And so, how does it benefit you to be in this type of fund that has all of these different tools just to protect your downside? Well, we call it the 3 Ds. That's what hedge funds do. So firstly, durability. If you're able to protect your portfolio when markets are going down, that means you have a much more durable portfolio, something that's very important to us. And then diversification. The market is great when it's going higher and higher, but when it's going down, you want to make sure your correlation is less. So with only 48% correlation over a 5-year period, that's how we've been able to protect on the downside. And then lastly, defensiveness. We're absolutely allergic to volatility, drawdowns, which is just, the market going down. We don't like that. And so over 5 years, our hedge fund has had much less volatility than the market, which means it doesn't go down as much. It's not very variable, going up and down. It's a lot more consistent over time. And, at a time when the market has had its worst month ever, it went down 22% over a 5-year period, our hedge fund only went down 3% at the same time. So it just shows you the power of those protection tools like shorting when the market is going down. And this just elaborates on that. So we did an exercise where we said over the last 10 years, if you took the 10 worst months in the market, so March 2020, worst, less worst, all like that with the blue bars. What did our hedge fund do in each of those months? And you can see that that red bar is a lot smaller than the blue bar. And it shows when the market goes down, the hedge fund doesn't go down as much. And we even have one example in August 2023 where the market went down, but our hedge fund went up. And that's all of that shorting and all these, the witchcraft, the fancy tools that we use. Don't tell my boss I said that. So at the end of the day, when we think about managing money as 361, we're actually quite conservative, even though everybody thinks hedge funds are very risky. They're risky when people use these tools irresponsibly. But we do the research, and over time, so this is, let me go this side, throughout the lifetime of our hedge fund, the blue bar is the market. So throughout all those months, whenever the market went up, our hedge fund didn't go up as much as the market. But importantly, whenever the market went down, our hedge fund didn't go down by as much. And over time, you've got this blended impact of that outperformance of the hedge fund, all from missing those worst days, if you remember the first chart. And so, not everyone can go 100% into hedge funds, we understand, which is why we think hedge funds are a nice addition to an existing portfolio. And so we did a little exercise where we said, traditionally what people do is they have equities and bonds. But what happens if you also add a hedge fund to that mix? Our hedge fund in particular. And what we found is that you had better performance, less volatility, and less drawdowns. So that equities and bond portfolio, that's the traditional safe portfolio that we always talk about. The worst drawdown it had, or the market had, was 24%, and our worst drawdown, when you added in the hedge fund, the drawdown was a lot less. So being able to protect on the downside is such an important concept in investing. And over time, it compounds quite meaningfully. And this becomes especially important when you have an investment product where there are income needs. So here I've given, it's my last example, I promise, Craig, where if you have an investor that's trying to invest a 2 million rand lump sum, and there are two scenarios. In the one, they just need a lump sum, and in the second one, they actually need some income. So they draw a certain amount every month. How does the hedge fund compare to this person putting that money in the market? Well, in the lump sum scenario, if they just put their money in the market, they make 11%, whereas if they put it in the hedge fund, they would make 15.5%. And now, in an income-producing scenario, if someone had just put their money in the market and withdrawing every month as they need that income, they would end up making 7% per annum. Whereas with the hedge fund, they'd end up making 12.9%. Now, how does that work? When you need to withdraw every single month, some of those months will be when the market is down, which is the worst time to be withdrawing. And so because the hedge fund gives you very consistent performance over time, it means that you can withdraw and you're not penalized over time. And so we think that all of these benefits are really important to highlight when you frame hedge funds, and just think of them as something that protects you on the downside and gives you consistent returns. And so this is the performance of our hedge fund. I've kind of shown how in those periods of stress, it didn't go down as much as the market, and you can see it over here. Especially during 2022, all of these high stress periods, the hedge fund has been consistently able to outperform, and with very attractive risk metrics. Small drawdowns, low volatility. So that's it from me. I hope that you learned something, and thank you.